Okay, welcome everyone. Today we're doing a deep dive focused entirely on Viasat's latest earnings call.
That's right. We're breaking down their Q4 and full fiscal year 2025 results, looking at the numbers and what management had to say.
Our goal here is really to pull out the key takeaways for you, what you need to know about where the company is, and maybe more importantly, where they think they're going.
Exactly. Think of it as getting the core story without wading through the whole transcript yourself. We'll hit the numbers, sure, but also the operational bits, the satellite plans, cash flow, competition, all that stuff.
Sounds good. Let's start with the basics then. The reported numbers for Q4 and the full fiscal year. Give us the snapshot.
Okay, headlines. For Q4, Viasat reported revenue of $1.15 billion. On the bottom line, though, a GAAP net loss of $246 million.
Okay, a loss on the standard accounting. What about adjusted metrics? They usually focus on adjusted EBITDA.
Right, and their Q4 adjusted EBITDA came in at $375 million. That works out to a 32.7% margin. They did call out a couple of things hitting that margin, though.
Like what?
A $6 million FX loss and about $18 million in non-cash write-offs tied to network integration. So they suggested the sort of underlying operational margin was actually a bit higher, maybe closer to 35%.
Okay, so a net loss, but the adjusted operating picture looks a bit stronger if you back out those items. How did the full fiscal year 2025 look overall?
For the full year, $4.5 billion in revenue. The GAAP net loss was bigger, $575 million. But full year adjusted EBITDA was $1.55 billion, giving them a 34.2% margin for the year.
And how did that compare to their own forecasts?
This was a key point. They stressed they actually met or beat their guidance metrics across the board for FY25, which, considering the ongoing integration of Inmarsat is pretty significant.
Yeah, beating guidance is definitely notable. Anything else stand out from the annual results?
Yes, two things. They achieved record growth in new contract awards. That's a positive sign for future business. And they highlighted positive free cash flow generation in Q4 specifically.
Cash flow. That's always critical.
Definitely. They generated about $50 million free cash flow in Q4. And for the full year, operating cash flow was over $900 million. That's up more than 30% year over year. Strong growth there.
Oh, okay. And looking ahead on spending.
They actually lowered their combined capital expenditure forecast for fiscal 25 and 26, reduced it by nearly $300 million compared to what they previously guided.
So let me summarize that snapshot. JAP losses, yes, but beating guidance, record contract awards, strong operating cash flow growth, positive Q4 free cash flow, and lower expected future CapEx. Kind of a mixed bag, but with some positive operational signals.
That's a fair assessment. And it ties into how they framed the year. They called FY25 a pivotal year.
Pivotal how? What do they mean by that?
Basically, they see FY25 as the year they laid the groundwork for multi-year accelerated growth and, importantly, sustained free cash flow. The idea is they're moving past the peak spending on the Viasat 3 satellites and the initial heavy integration work.
Right, the pivot is away from heavy investment towards reaping the benefits.
Exactly. Higher earnings potential combined with lower capital intensity, that's the formula they expect, will drive significant free cash flow going forward.
Makes sense. What specific operational things did they point to as achievements from this foundational FY25?
They listed quite a few. Integrating the first Viasat 3 satellite, Flight 1, was a big one. They said it's already showing benefits for user experience and network efficiency where it's deployed.
Even with its known issues.
Even with the antenna anomaly, yeah. They also hit key milestones on the roadmap for the other two Viasat 3 satellites. They mentioned positive feedback and initial installs for their new multi-orbit maritime service, Nexus Wave.
Okay, what else?
Introduced some network optimization tech, signed new deals for third-party network capacity, including, interestingly, using some ELO capacity.
Using ELO, that's interesting. Why bring in capacity from essentially competitors?
Well, they framed it primarily around the reducing latency for certain mobility users, think things that need really quick response times, and also capital efficiency, using other networks where it makes economic sense instead of building out absolutely everything themselves is part of that multi-orbit strategy they talk about.
Got it. Okay, let's dig into their own satellites. Viasat 3. What's the latest on flights 2 and 3?
Right, Flight 2, that's the one for the Americas. They've been doing corrective actions and testing on the antenna reflectors. Integration's progressing. The plan is still to ship it to the launch site this summer.
But the in-service date shifted slightly?
Yeah, they nudged the public roadmap timing for in-service to early calendar 2026. They said this reflects potential, schedule uncertainties after it ships launch prep, in-orbit testing, that sort of thing. But crucially, they stated This specific timing adjustment isn't expected to materially change their financial outlook.
Okay, so a slight schedule tweak on Flight 2, but not a financial game changer in their view. What about Flight 3 for Asia Pacific?
Flight 3 uses a different antenna design from a different manufacturer. It didn't need those same corrective actions. It's currently working through its antenna subsystem integration phase.
Yeah.
So moving along its own path.
All right, so Flight 2 shipping soon, service early next year, Flight 3 progressing. How is Flight 1 actually doing now, given the antenna issue?
They said usage is scaling steadily in the areas where it's effective. It's serving almost 2,000 aircraft now, accumulated tens of thousands of passenger flights.
Any proof points on performance?
Yeah, they commissioned a survey comparing user experience on Hawaii routes, where Flight 1 is primarily serving aviation against ILEO competitors on similar routes.
Yeah.
They reported very favorable results for their service. Their takeaway was that the real competition in aviation isn't just about, LEO versus GEO architecture.
What is it about then, in their view?
It's about delivering reliable, high-quality, free Wi-Fi consistently and providing airlines a single interface to manage the whole passenger service package. They really emphasize that their Viasat 3 design, with its aimable beams, lets them target bandwidth right at the planes, even wide bodies offering free Wi-Fi, despite Flight 1's limitations.
That ability to aim capacity seems core to their whole pitch.
Absolutely. They kept coming back to the idea that the competition is becoming more economic. Who can deliver the service levels needed, but do it profitably? That aimable bandwidth is key to their playing to win strategy, especially in mobile markets like aviation and maritime.
And they mentioned non-price value, too.
Right, like giving airlines control over the passenger experience. They argue that's crucial for airlines wanting to integrate connectivity into their brand and maybe even find ways to monetize it indirectly.
Okay, you mentioned integrating LEO briefly. How does that fit with their own big GEO satellites?
It's about optimization, really. They plan to use third-party capacity, including LEO, sort of judiciously. Maybe for latency-sensitive stuff, or where it just makes better economic sense for certain traffic. The goal is blending networks for the best overall result cost-effectively.
Got it. Let's shift gears a bit. L-band spectrum. They talked about non-terrestrial networks, NTN, for 5G and 6G. Sounds future-forward.
It is. And it leverages their legacy Inmarsat L-band spectrum rights, which are great for mobile direct-to-device type stuff. They're working with the Mobile Satellite Services Association, the MSSA, to build an open, standards-based ecosystem for these NTNs.
Why is open and standards-based the focus there?
Well, think about it. Current standards might let your phone talk to maybe one specific satellite network. What they're pushing for with MSSA builds on 3GPP standards to allow interoperability. So any standard-compliant device could potentially roam across multiple participating L-band satellite networks.
Like how cell phones roam across different carriers?
Kind of, yeah. The vision is more choice, more scale, potentially lower cost for users and device makers compared to everyone being locked into one proprietary satellite system. It mimics how terrestrial mobile evolved with shared infrastructure and standards.
Makes sense. So what are their actual business goals for this L-band NTN push?
Three main things. One, lower the cost, capital, and operating costs for building these open NTN space systems. Two, support and evolve critical safety services for government, maritime, aviation using these next-gen capabilities. Three, transition their existing direct-to-device business, which uses older tech, towards these emerging 5G standards as devices become available. It's about turning that legacy L-band asset into a future growth area based on open standards.
A clear strategy there. Okay, let's dive into the segment performance. Communication services, how did that look?
Overall, comm services revenue was down 4% in Q4 year over year. The main drivers were declines in fixed broadband and other areas, plus lower product revenue.
Well, weren't there offsets?
Yes. Those declines were partly offset by continued growth in government SATCOM services and, significantly, aviation services.
Aviation seems like the bright spot.
Definitely. Commercial aviation saw in-service aircraft up 10% year over year, and maybe more telling, the backlog for future installs was up 18%. That backlog supports future growth. Business aviation was also up 12% growth in aircraft online.
Okay, aviation strong. What about maritime and fixed broadband within that segment?
Maritime revenue dipped 8% in Q4. They did say they expect this to be the low point, the trough. They're installing their new Nexus Wave service, over 100 ships active, nearly 500 more ordered. So they see slight growth coming back in Q1 and year-over-year growth later in FY26.
And fixed broadband, still struggling.
Yeah, U.S. fixed broadband is still facing challenges, mainly due to capacity constraints on the current satellites. Revenue in fixed services and other was down 19%. They were pretty blunt about it.
So what's the plan for fixed broadband? Just wait for the new satellite.
Viasat 3 Flight 2 is definitely seen as pivotal for stabilizing and eventually growing that business. In the meantime, they are trying new service plans, focusing sales where they do have some capacity. They said these efforts are showing early signs of stabilizing gross adds and reducing churn.
But still expect pressure for a while.
Yeah, they anticipate continued subscriber pressure through most of FY26, but hope to see stabilization near the end of the fiscal year once Flight 2 is actually in service and they can start leveraging that capacity.
Okay, let's switch to the other segment. Debt defense, advanced technology. Sounded like that one's doing well.
Yes, DAT has strong momentum, and they expect that to continue. They're guiding for double-digit revenue growth in DAT for FY26.
Driven by what specifically?
Primarily two areas, information security cyber and space mission systems.
What's happening in InfoSec Cyber?
They're competing for next-gen encryption contracts, leveraging their high-assurance crypto capabilities. A big driver is the push in defense towards quantum-resistant encryption, basically a tech refresh cycle. Plus, growing focus on cybersecurity for space systems, protecting satellites themselves.
And space mission systems.
Growth there comes from things like technology insertions for NASA's Space Relay Network, developing inter-satellite links, optical and RF, working on international projects like the ESA Moonlight program for lunar comms, and various national security applications. Lots going on.
They mentioned something about royalties impacting DAT's profit growth, though.
Right. Royalties from TrellisWare were unusually high in FY25. They expect those to return to more normal levels in FY26. Since royalties are very high margin, this means DAT's adjusted EBITDA growth will likely lag its double-digit revenue growth in FY26. Margins excluding royalties are actually expected to improve.
Got it. They also mentioned potentially playing a role in something called Golden Dome.
Yes, some specific government initiatives. Details weren't provided, but it's another potential growth vector within DAT.
Okay, bringing it all together for the overall company outlook for fiscal year 2026. What's the headline guidance?
Modest revenue growth overall for the company, but adjusted EBITDA is expected to be roughly flattish compared to FY25, maybe plus or minus 1%.
Flattish EBITDA despite revenue growth, that seems like the key point. What are the headwinds holding EBITDA back in FY26?
They were very clear on this. About $60 million in extra cost for third-party bandwidth they need to buy. Around $80 million in higher operating costs, mainly to get the Viasat 3 ground network fully ready for flights 2 and 3. And as we just discussed, those lower TrellisWare royalties.
Those are pretty significant hits to profit. What's offsetting them?
Growth in the core businesses, aviation, government SATCOM, the DEED segment generally, plus about $40 million in savings expected from the voluntary retirement program they did last year.
Did they mention any external sort of macro headwinds influencing the outlook?
Yeah, definitely. Continued delays in aircraft deliveries from Boeing and Airbus that slows down their new aviation installs. Also seeing more aircraft temporarily taken out of service. How those play out affects where they land in the guidance range. And minor exposure, about $25 million annually to current tariffs.
So FY26 really sounds like a year of managing through these specific costs and headwinds while setting up for the future growth once the satellites are fully up and running.
That's exactly the picture management painted. They acknowledged the near-term EBITDA pressure, but stressed high confidence in achieving sustained free cash flow starting in the second half of FY26.
Driven by
the business momentum in growth areas, combined with that much lower capital spend once Viasat 3 is launched and operational. That combo is expected to lead to meaningful, growing free cash flow after FY26.
Speaking of spending, what's the CapEx number for FY26?
Around $1.3 billion expected for FY26. That includes roughly $250 million to finish off the Viasat 3 constellation final costs through launch and initial operations for flights 2 and 3.
Still a big number, but down from the peak years.
Exactly. It's a substantial reduction, and that reduction, paired with business growth, is why they're forecasting that significant free cash flow generation post-FY26.
And operating cash flow.
Remember the $900 million plus 30% growth in FY25? They're aiming for solid double-digit growth in operating cash flow again in FY26. Focus on working capital. Lower restructuring costs should help there.
Okay. Beyond satellites and cash flow, they talked about integration synergies boosting margins down the line.
Yes. They're actively working on streamlining the combined company. Things like network synergies, sharing capacity better across the fleets, maybe needing less future CapEx. Also using their larger scale for better purchasing power, cutting back on third-party staff, simplifying processes.
And the payoff, what's the target?
They don't expect much impact in FY26 itself. But over a 3-year horizon, they see these synergies adding an extra 200 basis points, so 2 full percentage points or potentially even more to their adjusted EBITDA margins.
2% on margins is pretty significant over time. All right, let's talk debt reduction. Seemed like a major focus.
Absolutely. Explicitly called a top capital priority. They laid out a 2-step plan. First, use cash on hand for near-term maturities. Second, use the expected business momentum and cash flow from FY26 onwards to tackle the longer-term debt structure.
How much cash do they have?
They ended the quarter with $1.6 billion in available cash at the consolidated level.
And they've started using it.
Yep. Just after the quarter ended, they paid off $443 million of notes due in 2025. And in FY26, they plan to pay down the remaining Inmarsat term loan, be about $300 million again, using cash.
Any other potential sources for debt paydown?
They mentioned any cash from their ongoing strategic review of certain assets, or if the Legato situation resolves favorably, that money would go straight to paying down debt faster. They also plan to move cash, about $500 million, from the Inmarsat part of the company up to the Viasat parent level to help manage debt more centrally.
So actively managing the near-term debt and lining up future cash flow for the rest. Do they have a target leverage level?
Yes, they stated an initial goal of getting down to around 3 times net debt to adjusted EBITDA leverage. They see that as a more efficient level for their cost of capital and better for equity value.
Okay, a clear target. You mentioned Legato briefly. What's the latest there? Just a quick update.
They just reiterated their position. Legato dropped its first suit when Viasat filed to dismiss, then refiled a similar one. Viasat maintains the case has no legal merit and contradicts Legato's own previous statements.
And the potential money involved?
Still excluded from all their financial forecasts and guidance. It's pure upside if it resolves in their favor. They did remind everyone the amount owed is public record, over $500 million. Significant potential cash if it comes through.
Right. Okay. Pulling back to the big picture again, how did they frame their competitive position, that playing to win idea?
Yeah, playing to win means focusing on profitable growth in markets where they think they have an edge. Aviation, maritime, government, land, and mobile, they see competition increasingly boiling down to economics, delivering the service reliably and profitably.
And Viasat 3 is the key weapon there.
That's the idea. The dynamic, aimable bandwidth is positioned as the differentiator, letting them put capacity exactly where demand is highest when it's highest, efficiently. They also stress that non-price value again, especially for airlines, giving them control over the passenger experience, enabling things like free Wi-Fi as part of a broader airline strategy, not just a cost center.
How did they specifically counter the Starlink competition narrative, especially in aviation?
They tackled it directly. Said their own performance data from actual flights, narrow and wide body, shows they meet the demanding requirements of sophisticated airlines. They argued the Viasat 3 aimable bandwidth is enough even for big wide bodies offering free Wi-Fi, citing positive feedback already from Flight 1 customers.
So their argument is less about raw total capacity and more about usable, targeted capacity delivered economically.
Exactly. It's about having the right capacity in the right place at the right time to meet demanding needs profitably. That's the core of their competitive argument based on the Viasat 3 architecture.
Okay. So listening to this whole call, you definitely get the sense of a company in a major transition phase.
No doubt. Managing through the end of huge capital spend, integrating a massive acquisition, all while trying to pivot towards generating significant, sustained free cash flow beyond this current fiscal year.
And those satellite roadmap updates are obviously critical. The timing of Flight 2 and 3 directly impacts when that future capacity comes online to fuel their strategy in aviation and maritime.
Absolutely. And that L-band NTN strategy, while longer term, is really interesting, positioning them in that next wave of connectivity by pushing for open standards, using their unique spectrum.
And despite the near-term EBITDA headwinds they laid out, the performance and date in aviation does suggest some underlying resilience and growth engines are firing.
Yeah, those are the areas they're clearly counting on to carry the growth load, especially while fixed broadband waits for capacity.
And the debt reduction plan is front and center, aiming to fix the balance sheet as that free cash flow hopefully starts rolling in.
A crucial piece of the puzzle to get to that target leverage ratio and improve the overall financial health.
Okay, that really breaks down how Viasat sees things based on their call. Now, as we always do, let's shift gears for a moment. Time for some purely hypothetical scenarios based on what we just heard.
And let me jump in with the usual very important disclaimer. This is purely for discussion, exploring potential interpretations. Absolutely not financial advice. Do your own research. Consult professionals.
Couldn't agree more. Purely hypothetical provocations. Okay, idea one. You could look at a contrarian long position. The idea hinges on the timing of Viasat 3 coming fully online and management sounding pretty convinced they can monetize it effectively. Right now, the market seems focused on that flattish FY26 EBITDA guidance and the macro issues like plane delivery delays.
Right. But the pitch would be, Flights 2 and 3 mean a huge jump in sellable capacity hitting the market by early 2026. Management believes this capacity is differentiated, aimable, high performance, right where demand is exploding in mobility markets where they already have contracts and backlogs.
So the hypothesis is the market might be underappreciating the revenue and margin power this unlocks in FY27 and beyond, driven by more planes using more data, especially with free Wi-Fi becoming standard, all served by this new flexible capacity.
Exactly. Layer on top of that the potential 200-plus basis points of margin uplift from integration synergies kicking in over 3 years, plus any potential windfall from Legato over $500 million, or asset sales from the strategic review. You got multiple potential upside drivers not reflected if you're just looking at the FY26 trough. It's a bet on the tech and the economic strategy winning out over near-term headwinds.
A plausible scenario if you buy into management's execution capability and the tech's potential. Okay, what's the flip side? Idea two.
How about a potential short chaos, focusing on companies stuck with older, legacy fixed satellite broadband tech, especially those in capacity-starved areas that don't have the dynamic allocation Viasat claims for Viasat 3.
Interesting angle. The logic.
Yeah, well, Viasat basically admitted their own fixed broadband is hurting until Flight 2 brings capacity relief. But they also said they're already seeing stabilization efforts work even before that new capacity arrives.
Implying that once Flight 2 is online,
Implying that Viasat could become a much fiercer competitor in fixed broadband where they choose to point that new capacity.
So the hypothetical short play is that this renewed Viasat competition, armed with fresh, flexible capacity, could really squeeze legacy providers, accelerate their declines, or make it harder for them to recover, especially if they lack the tech agility.
Precisely. It's a bet that Viasat's new capacity deployment could disrupt competitors relying on older, less efficient architectures in the fixed market. You need to identify who is most vulnerable based on their tech and market exposure, of course.
Makes sense as a potential consequence. And again, folks, purely hypothetical scenarios based on the earnings call narrative, not investment recommendations.
Absolutely critical reminder.
Okay.
Let's wrap this up.
So summarizing the call, Viasat got through what they termed a pivotal FY25, showed decent operational performance, made strategic moves, but still reported a GAAP loss.
FY26 looks like a transition year. Flattish adjusted EBITDA expected due to those specific headwinds we discussed, bandwidth costs, ground network readiness, lower royalties, but they see it as essential setup for future accelerated growth, and that all-important sustained free cash flow kicking in late in the year and building from there.
Key growth is pegged to aviation, government, and debt, all fueled by the Viasat 3 rollout, using third-party capacity smartly, and focusing on high-value markets and tech like L-band NTN.
And definitely, tackling the debt is a major priority, using the cash flow they expect to generate to strengthen the balance sheet.
It really leaves us with a final thought for you, the listener, to ponder. Viasat is pushing hard on their own advanced satellites like Viasat 3, with all that capacity and aimability. But at the same time, they're championing open standards and integrating third-party capacity like with L-band NTN and using LEO.
So the question becomes, is the whole competitive landscape in satellite connectivity shifting? Is it becoming less about just who owns the most satellites in orbit?
And maybe more about who can most effectively integrate and manage diverse capacity their own, others, GEO, LEO, whatever, efficiently and economically, to deliver the services customers need profitably.
It's certainly a complex balancing act between proprietary tech and open ecosystems they seem to be navigating.
Something to think about. That concludes this deep dive.